Hi, I'm Kevin Nunez, investor, entrepreneur, and professor. I grew up in a part of New York City where nobody was talking about saving or investing. We were in survival mode. I earned my bachelor's degree from Fordham University and an MBA from Cornell University. I worked my way up Wall Street firms like Morgan Stanley and Merrill Lynch. I did everything you're supposed to do. And I could have kept climbing that ladder, but I chose something different. I chose to build. I chose to teach. I chose to invest in our communities because too many families are often fed bad information about money and it costs them generations. So this is Invested in Us, where we break down money, markets, and ownership so our communities can build real wealth and real legacy. Hey everybody, my name is Kevin Nunez, founder of NJK Partners, and welcome back to another episode of Invested in Us, where we explain money how it should have been explained to us. Alright friends, so let's talk about the state of capital, and wow, it's been a pretty volatile ride these last couple weeks. The S&P 500 as of last Friday, March 13th, finished down 2.9%. Now remember, the S&P 500 is America's largest publicly traded companies, about 500 of them. Then you got the Russell 2000, which was up about 7% just 5 minutes ago, and now is basically flat on the year. Remember friends, the Russell 2000 is roughly 2,000 of America's smaller publicly traded companies. We're seeing a huge dispersion, right? We're seeing a huge difference in performance just within those subsectors. Let's talk about the S&P 500. The S&P 500 energy sector is up about 30% year to date. Compare that to the S&P 500 financials, which are struggling because of their private credit, aka their lending strategies. That's down double digits year to date. I mean, that is huge difference in performance just within the same subsector. So this is important because if you're out there day trading thinking you're going to buy a stock at $100 and sell it at 101, or you're coming in at the S&P 5, like the message here, it's important to know what you're buying because there's huge volatility just within the same indexes. You know, we're still watching value stocks outperform growth stocks. Historically, growth stocks have outperformed value stocks. Remember, friends, growth stocks are supposed to be reinvesting into their business and growing at a faster clip. Right now, we're watching value stocks, which, typically are more mature, more quality, orientated companies, underperform growth stocks. And that's because instead of taking their profits and reinvesting it, they're taking their profits and giving it back to the owners, giving it back to the shareholders in the form of distributions and dividends. So, we're seeing a huge rotational shift in the marketplace. And, this is largely, honestly, in my humble opinion, I'm kind of surprised that the S&P 500 is only down 2.9% year to date as of last Friday, considering all the craziness that has happened year to date. If you think about this, from a macro perspective, the Supreme Court justices ruled against the tariff policy. So now investors have to reprice all these companies that were previously paying tariffs that may no longer pay tariffs. Then you have the war in the Middle East that has broken out. And obviously the energy markets are volatile, but that's impacting every other facet of the market. So, I'm kind of surprised that the S&P 500 is only down 2.9% year to date. Considering all the chaos that's out there. Frankly, we are in what I like to call a, governing by tweet policy. Governing by tweet era. So, any post or anything that comes out from this current administration can sway markets in either direction. That makes it a very, very difficult environment to make investment related decisions, especially if they're long-term investment related decisions. And this is why I always go back to, the importance of diversification, the importance of knowing what you're invested in, the importance of knowing what fees you're paying, and knowing, how this all impacts your taxes and your underlying goals. There's no skipping steps here, friends. You got to do the homework. You got to do the diligence. And in continued volatility, the 10-year treasury, remember, friends, a 10-year treasury note is basically you lending the government, federal government, money for about 10 years. That has also been very, very volatile. We saw it up around, 4.25 a couple weeks ago. Then it closed under 4% like 2 weeks ago. We were talking about it here on Invested in Us. And as of last Friday, it closed back up around 4.28%. So that means mortgage rates went back up. Likely car loans would be impacted. Credit card rates would be impacted. So these decisions have ripple effects in the marketplace. So it's important to understand what's happening in the marketplace and not only how to play your portfolio, but how it impacts your everyday life. All right, friends. So on today's breakdown, we're going to keep it real simple and real high level. There's essentially two things that can get an investor a return on their investment, right? And in finance, we call it a ROIC or MOIC, return on invested capital, or multiple on invested capital. But at the end of the day, an investor can get their money back one of two ways, if not both ways. Either appreciation, and in this example, you can buy an asset, whether it's a stock or a property. You can buy an asset for $1 and sell it for $2. In that example, you made a 100% return on your investment, right? Your MOIC is 2x, right? Because you doubled your money. So that's one measure of performance, right? Appreciation. Another measure of performance would be income, right? So if you buy a business or you buy a stock or you buy a property, how much cash flow, right? How much income is that asset providing? That's the second measure. Some investments are solely an appreciation play, right? Where you can double, triple, maybe 10x your money. Some plays are income driven, right? The appreciation might not go up as much, but that cash flow is going to give you monthly, quarterly, annual dividends or distributions. So again, folks, on the breakdown, the message here is that there's two ways an investor should consider, an investment. Either appreciation, right? It's going to go up in value. It might double, triple, quadruple, hopefully one day. Or you're going to get some sort of income. And ideally, with the income, you get enough income that you get a return on your investment. So, think about it that way when, you're conducting diligence on a potential investment, either a stock or a property or something in between. What is this going to do for me? Is this appreciation, income, or both? All right, friends, so now let's talk about the property play. Now, when considering a investment in real estate, you should always be thinking about what's the risk-adjusted return on this potential investment, aka does the risk associated with that investment line up with the potential return on their investment? And pretty much in real estate, you want to break it down one of three ways, right? Let's not make this any more complicated than it has to be. If it's a core asset, right? In real estate, we call core properties basically, cash flowing, fully stabilized trophy assets, sort of say, right? Doesn't need any renovations, usually fully occupied, usually getting the highest premiums in rent, right? In that income. All right, so now let's talk about value add. Now, value add is basically like renovations. Think we might be painting some walls, think we might be doing some hardwood floors, think that, the property isn't getting the maximum rents, or maybe it isn't fully occupied. But essentially, a value add is going to need the owner operator, who might not be the same person or entity, by the way, but it's going to need that operator to do some value add investments, right? And that way, after the value is created, right, after you pull those levers to create the value, whether you're painting or doing something, now you can charge more money for the rent, right? Now you can charge a premium for that asset. You might have with the renovations, you might have converted it from a Class B asset to a Class A asset, which now justifies the increase in rent and premiums and stuff like that. So that would be value add. And then you have opportunistic. And opportunistic is the riskiest. Opportunistic, when you simplify it, is basically ground up development. It's basically digging a gigantic hole somewhere and building something up, brick by brick, something out of nothing. And because there's so much risk associated with opportunistic investing, that in theory should pay the highest return on your investment. Why is there the highest risk associated with opportunistic? Well, it's not just painting and, charging more money for your rent. This is a lot more complex. Because to dig a hole in the ground somewhere, you have to think about the permitting process. You have to think about the environmental reports that the local municipalities are going to want you to do. So, there's all sorts of town halls that take place before you can actually dig that hole. And let's just think about it from an economics perspective. That permitting process might drag out for a few years. And then that's long before a shovel hits the ground. That's long before you get a single dollar in cash flow, which doesn't necessarily mean profitability. So these opportunistic plays can take years to drag out, and because there's so much risk associated with that time frame, right? During that time frame, you might have inflation, right? The cost of the materials might spike up, making that property more expensive, right? The cost of labor might spike up, right? Who knows? There might be some immigration policies where there's labor shortages in that subsector. I don't know. So that might drive the cost of labor up. And what happens when the cost of labor goes up? What happens when there's external shocks to the commodities market driving those commodities up? I don't know, like war, inflation, or some of those things. That's inflationary, driving the cost of that project higher. So there's such a long time horizon from when an opportunistic play gets penciled out on the back of a napkin to the point where it's actually profitable, that there's so much risk associated that it only merits a higher return on your investment. So when you think about real estate, let's not make this any more complicated than it has to be, friends. Opportunistic is the riskiest, so you should expect to get a higher return on your money, right? Scare money don't make money. So if it's opportunistic, you should expect to get a pretty, nice return on your investment. If it's value add, it's less complex, right? Which means you shouldn't get as much as you would if it's an opportunistic play, because you might be able to bypass the permitting stage. You might be able to bypass the, some of these things and just do light value add, increases. Or if it's a core, this is essentially a trophy asset. This is something that's already fully stabilized, already fully renovated, and already cash flowing. And because the risk are no longer there, or at least significantly reduced, a core asset will not pay you as much from a return on investment perspective than some of those other asset classes. So plan accordingly when looking at these deals. I always tell my real estate students, let's not take opportunistic risk and then, realize core-like returns, because that's a huge, misuse of money. All right, friends, so now let's talk about policy and economics. And my goodness, the policy environment is pretty volatile. Last week, a judge tossed out the court case against one of the members on the central banks. Now, why is that important? Not because I want to go down the political route. This is important because from an investor perspective, we always want the central banks to be independent of the political environment. That is important from an economics perspective. We need the central banks who basically control monetary policy, right? How much money is in or out of the system, and basically control, interest rates. We need them to not worry about the next election. We need them to focus on what's best for the broader economy. And in the case of the U.S., our economy is about, 150 million employed people. We need them to worry about what's best for the greater good, not about the next election. So investors like last week's ruling because it signals that the central banks will be independent of, any political intervention. And that's important because when we think about monetary policy, how much money is in or out of the system, too much money in the system could be inflationary. Too much money out of the system, also has its impacts. Or high interest rates can throw a curveball at an economy and slow it down. And very, very low interest rates can heat a market up and, we all know about what happens, during bubble-like environments. At some point those bubbles do tend to crash, like it did back in 2008. So it's important to have a central bank that's independent of politics, that focuses on the greater good, not the theatrics of Washington D.C., but more so the policy that impacts the everyday person, the everyday, investor, and make sure that they're calling balls and strikes and not focusing on swaying it one way for one political team to win, so to say. All right, friends. So in today's conversation, we'll keep it high level, because the message here is that with everything that's happening in the world, whether it's tariffs, whether it's court cases, that's impacting the markets, whether it's war, whether it's just regular everyday policy, it's no one really knows how the markets will react to these things. So the message here is that you always want to be aligned with, your goals, with your time horizon, and you want to rebalance your portfolio on a periodic basis. That allows you to focus on what's important, which is your goals, and allows you to reduce the external noise and focus on what's important. And, that's how professional investors manage their day to day. They're not out there, for the most part, they're not out there day trading, trying to come in at $100, exit at 101, and hopefully they, now can retire and move to, Florida or something like that based off of the one trade. It's all about process. It's all about having a philosophy and a process that removes the emotion, removes the noise, and focuses on what's important. So with that, we thank you for joining us for another episode of Invested in Us. We're going to ask you to join us across all social media platforms at NJK Partners. You can follow me directly at Kevin Nunez NJK. Please visit our website, if you want to shoot the shit, or you want to, maybe schedule a consulting, for your financial plan, njkpartners.com. Of course, we're going to ask you to subscribe to our newsletter and our YouTube channel. So, with that, thank you again for watching Invested in Us, where we explain money how it should have been explained to us. Peace, y'all.